This is the Accredited to Accredited show, where real investors, not academics, help other investors to achieve financial freedom and grow their wealth. Here's your host, Gena Lofton.
So Bill Trimble is on this show today. It's Gena Lofton. I have Carl Johnston here, and this is the 88th show. And I wanted to spend time with Bill to go over this whole warrant process. So Bill, why don't you give a little brief background? I know you've done it before on your experience in this brokerage world and how you know about warrants.
Well, I've been in the security industry, the brokerage industry, and venture capital industry for 35 years, and I've participated in hundreds, if not 1,000, private placements where typically you would receive a warrant with your security package being a share and, of course, the warrant. So lots of experience on getting warrants, lots of experience on exercising warrants, and lots of experience on having warrants expire worthless on me. So we've got it all covered. Excellent.
Well, thank you so much for that. So, and the reason I wanted to get your time today is to educate myself as well as the audience of the show on how this warrant process works. So let's go through kind of just some rundown, very generic kind of like level setting as to what is a warrant first and foremost.
Okay, so a warrant is a security, and what typically it will come with a private placement. A private placement being a financing that's being done by a public company to a brokerage firm or to individuals through the regulatory channels. It's announced by a company. Private placements will have at least a 4-month hold on them, and for an inducement, they're usually priced below the current value of the market, and they typically will come with some type of a warrant. Warrant could be 6 months long, could be 5 years long, could be exercisable at the current market, not below it, like the private placement actual reduction, but could be also priced a lot higher, could be a half a warrant, could be a full warrant. So there's, depending on the company, depending on the market cycle, depending on, the sector, and the desire for a particular financing or not, warrants are sweeteners. And so what does a warrant give you the right to do? It basically is an option, although it is not an option. It gives you the right to buy, or an option to buy, X amount of shares at a stated price at a stated time. So if the stock that you bought was trading at 50 cents, you bought your private placement at, say, 50 cents, you got a warrant allowing you to buy another share in 2 years at 60 cents. No matter how high the stock goes, the warrant gives you the right to buy, if it's a full warrant, another share at 60 cents up until and including the second anniversary if it's a 2-year warrant. Very few exceptions that happens. The one exception is that some companies build in a force exercisable clause. So if the stock trades above, say, $1 in this example, for 30 days or 15-day trading days, they have the right to force you to exercise your warrant. But they're quite rare, so we won't spend much time on that.
Gotcha. And is that also called like an accelerator? Or is that different?
Well, it's a forced conversion. And an accelerator, that could probably be used, better terminology used, because it's just a strike price where once the company trades at that level for X amount of days or weeks, you're forced, you need to exercise or they expire worthless.
Gotcha.
And of course you're going to exercise them because they're in the money.
Excellent. Okay, no, thank you so much. So how are you notified on a warrant expiration or of a warrant that is expiring?
Typically you are not. It's kind of up to the holder of the warrant to know that, one, they caught the warrant, where it is, and on the warrant, it's a very definitive date of expiry, and again, most times you'll see 2-year warrants. So let's just say your private placement closes, you get your stock, you get your warrant certificate. Now, what do you do with it then? In my case, I deposit my stock that is restricted for 4 months. I can't sell it, but I can deposit it with my favorite broker. And if you don't use a discount broker, you can also deposit your warrant certificate. So in my particular case, I might have right now 30 different warrants. And if you have that many warrants, clearly you want to know where they are, for starters. Some people just put them in the desk, put them in a safe or whatever. And that's not the right way to do it unless you have them all together and you keep on top of them. If you go that route, you definitely want to have an independent list that lists both the company, the warrant exercising strike price,
Yeah.
and you want to have the expiry date. You want to have the details of the warrant listed for you so it's easy to look at. You don't have to keep going back to your warrant certificate. In my case, if it's with my broker, I see on my daily printouts that I have this particular warrant there, and it will show the date of restriction on the warrant, but not the expiry. What I mean on that is when you get it with a private placement, you can exercise the warrant prior to the 4-month expiry or the tradability of the stock, but you can't sell the stock. So you clearly would never exercise a warrant prior to the stock becoming free trading. There would be no rational reason for you to do that. Even if the stock doubled, you still couldn't sell that stock if you exercise the warrant. The warrant has the same restriction on tradability as your private placement does.
Gotcha. No, thank you. That's very, very helpful. Okay, so can you explain maybe the end-to-end, or before we go there, what if your price rises above the exercise price? How do you know that happens, or when do you know? Is there a trigger that you're notified of via a tool that you use or your brokerage uses?
Well, let's qualify. There are basically 2 types of warrants. One is non-tradable, and therefore non-transferable, other than you exercising and ultimately getting the stock and selling it, if that's what you're going to do. And then tradable warrants. Tradable warrants trade like stocks do, only they trade as warrants, and they have a factoring in the valuation that follows what's called the Black-Scholes model, which we'll talk about in a minute. And I'm sorry, let me correct that. They're valued based on the market. The market should value based on the Black-Scholes model, but the markets don't necessarily value things sometimes on logic. Sometimes it can be done on, what's hot, what's not hot. So back to the warrants, there's non-tradable, tradable warrants. So if you have non-tradable warrants, there is no mechanism that I'm aware of that will immediately alert you to the fact that your warrants are trading in the money. That is, the price that you pay to exercise your warrant to get a share is lower than the current trading in the market of those shares. So one has to manage your warrants much like you do looking at your stocks, where you know that you paid. If you got a brokerage account, you presumably have your cost of entry, and you have a daily print that shows what the current market is. That would be applicable on a tradable warrant, but would not be applicable on a non-tradable warrant. So you've got to keep on top of non-tradable warrants, is what I'm saying.
I got it. Okay. All right. No, thank you. And perfect. And so do you have like a process that you do for your own portfolio of keeping track of non-tradable warrants that you would like to share?
Yes. So one is I lodge all my warrants with the same broker. And so therefore, it within my personal account or my corporate account, I have virtually all of my warrants in two accounts. So I can see them. I also keep an independent warrant list that shows me all of the issues that I need to know when I receive them, how many I have, obviously the company, the tradability of the conversion of the warrant, and the ability to convert the warrant and sell the stock, that date, so the private placement restriction date, the exercisability of the warrant as far as how much it costs, and obviously the expiry of it. So on my personal handmade, personally made, tailored for my liking, I tend to run my warrants in order of the tradability of the stock and the expiry of the warrant. So it's one of the problems that you get into is if your warrants expire on you, there's not a lot of companies that send out notices to you saying, hey, look, you're in the money on your warrants. They're expiring in a week. You should be exercising them. Venture companies have a lot of things to do, and they don't typically have a lot of staff to do something like that. So I know that companies that I've had bigger positions in, that I'm close to, they tend to alert people when they're getting close, because it really is a financing for the company that's free. And warrants a pretty good tool for a lot of companies down the road if they have a liquid stock, because it gives the company ongoing revenue, because that warrant, when it gets exercised, is direct cash into the company's treasury without a commission.
Right. So would you say that they have a big incentive to get the warrants exercised or not?
A lot of it has to do with the actual liquidity in the company itself. If a company is not overly liquid, warrants can be a hindrance, especially when they're in the money, because people exercise them, they sell the stock,
right,
once the warrants are converted, and it's more pressure on a market. So that's when you've got issued and outstanding versus fully diluted. Fully diluted typically is warrants, options to directors and officers and staff of the public company, and in some cases a convertible debenture or of some nature, but you don't see a lot of that on the venture board or the resource sector unless you're dealing with mid-sized producers and so on and so forth. But typically the kind of companies I'm involved in, there's two dilution factors: warrants and options. So if you have a company that's got 50 million shares out issued, what's fully diluted? It might be 65, 70. And when you factor in the fully diluted, you should be factoring to the actual, if it does get exercised, everything gets exercised all at one time because the stock's going to take over. What does that increase the treasury by? So, it's yes, it increases the issuance, but it also increases the treasury of the company.
I see. Okay, no, thank you. So let's spend a little bit of time on how this whole process works from beginning to end of exercising a warrant in a very dumbed down way.
Really simply, if you have a full service broker, I would recommend keeping the warrants with them, and you give notice to your broker that you want to exercise warrants, and specific warrants, obviously, and that broker will put in through their back office the request, which goes through the transfer agent of the company and obviously the company for them to sign off and verify. And, the turnaround time for me is 4 or 5 days, typically. Sometimes it's dependent on seasonality. If it's really busy time of year for transfer agents and brokers, Christmas being one, it could take a little bit longer. But Typically, sort of 5 days. In the U.S., it's probably longer because of if it's a Canadian listed company and it's an American brokerage firm, I would bet 100% it would be longer. But there's a turnaround time, so let's just say it's 5 trading days. And at that point, you've got your stock, and if you're a sophisticated investor, you might say to yourself, look, I want to exercise these warrants today, and I want to get that price in the market today. I don't want to wait 5 days to see what the markets do. So you could short against the exercising of the warrant. You've got technically a covered short, although it would be declared as a short, but failing, reasonable delivery time, you probably wouldn't get caught with poor delivery or bad delivery and forced on a cash buying, which is yet another subject. So the process is straightforward. Exercise my warrant, get my warrant, sell my stock. You don't usually exercise a warrant unless you're going to sell the stock, or you really like the stock, but the warrant's expiring, and you want to continue to add to your position, and obviously you're adding to it at a discount to where the market's trading. You would never exercise a warrant if it's expiring and the stock's trading at a discount to your cost. Why would you do that? Just go buy the stock in the market.
Gotcha. Powerful. Thank you. Wow, great. Explain a cashless exercise.
A cashless exercise?
Yes.
A cashless exercise would be, off the top of my head, that term is probably used somewhere, but I haven't been familiar with it. It would be where you are exercising a warrant without putting up cash. You have to put up cash to exercise the warrant. Probably that would equate to what I suggested, shorting the actual stock, therefore generating the sale already, and that sale proceeds ultimately would be used to pay for the warrant. But I'll put a caveat in there. If you're shorting the stock, you got marginability that you got to factor in. So on a micro cap stock, so if a stock's trading at 50 cents, most brokerage firms in Canada charge a 50% plus premium. So when you short a stock, it's in a margin short account, and you need to have the capital to support the volatility of the particular share price during that period that you're covering with your exercising of the warrant. So I'm not familiar with any other way to pay for a warrant other than you pay for it, you got it, or you pay for it through the proceeds of the sale you've already completed through a short.
Got it. Thank you. Okay. And then next question is, what is the process for a decision to issue a warrant and the criteria for issuing the warrant and the price? So if let's just say a company that's a publicly traded company, how do they go through the process of whether or not to issue it and determination of the price?
Most cases, if you're dealing with a broker private placement, it's negotiating with the broker. If it's the best efforts, there's going to be likely a warrant attached. If it's a bought deal, to get a bought deal done before a public company, they may negotiate really well and not include a warrant, or they may be negotiated into including a warrant to get a bought deal done. Typically speaking, when private placements are done, because there is a 4-month hold on it in Canada, you are in a situation where you have to incentivize people to buy this private placement from the company, which is fine. Whether you buy it out of the market or you buy it from the company, you're still getting a share. You have to incentivize them the fact that they cannot sell the stock for 4 months. So you do that through one of a few ways. One is, of course, a discount to the current market, and 2 is a warrant. And a warrant, again, can be broken into different terms, different strike prices above market, and, of course, different sizes, whether it's a half a warrant or a full warrant. And in some cases, I've actually seen a quarter warrant. So it takes 4 warrants to get 1 share, and so on and so forth. So companies tend to when they're, when the markets are really hot and there's a hot sector going on, and they're raising capital through a private placement, they do a non-brokered. It's hard for them to go phone people, where it's actually not really allowed to phone people and start soliciting a private placement, which has been announced. So they have to sort of decide within their own board of directors what is going to probably sell. So if you're in a hot market, you can be very sharp penciled on what your private placement's priced at, and of course what if in fact you even have a warrant, and if you don't have a warrant, so be it. If you do have a warrant, what are the terms? In a tough market, much like we've gone through in the resource sector from 2001 to 2016, warrants were just an absolute. And in some cases, if the companies were fairly big in their tradability and, reasonably, well-defined already in their assets, but their stock prices were suffering, you were getting negotiated into 5-year warrants that were tradable. Tradability on a warrant is really the ultimate, because you have daily liquidity. You don't have to go through the process of exercising. You sell it just like you would sell a stock. But they tend to be a little more illiquid on both sides. The company itself knows that these warrants are not going to be exercised. They're going to be trading for the term of their warrant, and it's really another instrument that they didn't get anything for. Very rarely will somebody, unless there's a complete diversion in the price of the warrant compared to the exercisability and the strike price, and the warrants are selling at a huge discount, which professional market players would jump on, and so even if there was, it wouldn't be that much. So these warrants are going to be trading for 5 years. They're going to be trading for 5 years, unless of course there's a takeover. So a lot of companies don't tend to issue tradable warrants. The companies that do tend to be larger and very liquid on their shares, and they got negotiated into tradable warrant.
I see. So that leads me to this question. Is there a difference in the procedures of exercising the original warrant that was issued during the private placement to that which was purchased on the open exchange, which is a tradable warrant, correct?
Well, for as many tradable warrants that I've had over the many years, I do not recall ever exercising one of them. I have sold all of them. So because there is a liquid market like shares, you would be in a position to probably just sell your warrant and never tradable warrant and never need to worry about exercising it. The few exceptions I would, off the top of my head, would be where, again, there's a price imbalance that makes sense for you to exercise, and or a takeover where that's included in the mechanism for the takeover. Typically, when you have a tradable warrant, you're buying it and selling it no different than a stock. Conversely, if you have a non-tradable warrant, non-transferable warrant, it's up to you to determine when you're going to exercise it and when you're going to sell the stock that it converts into. So managing non-transferable, non-tradable warrants is a much bigger effort than tradable warrants. Tradable warrants are easy because you just put it with your stock quotes. They're quoted the same as a stock, and you get all the size, bid offers, it's been on your system, and you know what's going. You can see everything. You can see the historical, you can see the daily patterns, you can see even the chart. You do not see that on non-transferable, non-tradable warrants.
So the tradable warrant that is you could just trade on the open market, it could have originated from the issuer directly, and or it could have been issued or exist because of the original owner of the warrant exercised their transferable warrant.
If it's a tradable warrant, once the warrant is exercised, the company is going to take the warrant out of circulation and deliver the stock against the strike price.
I
It's a
see.
tradable warrant. Again, you don't see that happening. They trade like securities. The non-transferable warrant, once you exercise it, the company's issuance is obviously going to increase, and it's fully diluted going to decrease because they've canceled the warrant because it's been exercised, and they've issued the stock because you've exercised it.
Gotcha. Okay. Yeah. No, this is helpful. My whole idea of what this meant has now been clarified. I appreciate it. Let's go back to this Black-Scholes, model. Can you give us a really simplistic definition of what that is and why do we care?
Yeah. So the Black-Scholes is a broker. All broker firms have a system where they enter in the stock price, the strike price, the maturity of the warrant, and the volatility percentage for the last year of the stock. And basically, it spits out the value for a warrant that's not trading. They retrieve the volatility percentage typically from Bloomberg. So it's really taken into account how long this warrant goes for, what the price is, what the stock price is, the strike price of the warrant, what the stock price is, the volatility and the volume of the company. So if you have a very illiquid company and you have a massive warrant position, those warrants are going to probably have a lesser value to them under the Black-Scholes as something that has a very liquid, daily volumed stock. And it tends to be. Look, I don't analyze my warrant value on a Black-Scholes that often. I do it in my head very quickly based on two things. One, the length of the warrant. How long is it good for? Is it good for 4 more years? Is it good for 5 years? Is it good for 1 year? Is it good for 3 months? And the lesser time that you have to exercise the warrant, the lesser it's worth, period. The next factor is the big one, of course, is the strike price. If your stock is in the money, and depending on how much it's in the money, so if your exercise price is 50 cents, and the stock's trading at $1, you have an intrinsic value of 50 cents right now. Now, if the warrant's good for another 3 years, again, depending on the volume, depending on volatility, there will be an amount that you could safely apply per year on the value of the time. So if it allows me 3 more years, I might put 5 cents to that. So if I have a 50-cent strike and 3 years, I might say, well, 50 cents plus 5 cents a year, 3 years, I think that warrant's worth 65 cents. The Black-Scholes actually will give you the clear definition of it as far as Canada Revenue Agency is concerned and as far as a real, sound, practical valuation basis. For me personally, look, I look at a company, I see a stock chart, I look at a number of factors that I look at and I say, you know what, I'm happy here exercising my warrant, I'm in the money 50 cents. Yes, there's 2 years left, but I think the stock's had a big move from 20 cents to $1. Yes, there's more upside. Maybe I could short against my warrant because I think the stock's going to pull back. So it's kind of a covered short, if you want. But at the same time, you know, with the volatility in the resource sector, or for that matter, any sector that's venture orientated, you've got to make a call. No different than you make a call on selling a share. You know, if you fall in love with something and you want to own it until the ultimate day of it being taken over or it turning into Amazon, then, you know, you probably wouldn't look at selling your shares, and when you want to go to exercise your warrants, you're exercising because your expiry is coming up and you're in the money.
Thanks, Bill.
Depends on your philosophies.
No, got it. No, thanks. Because for me, let's just say a person who has warrants, just to arbitrarily say it's 20% above the money, to sell with just that bit of information is probably doing themselves a disservice. Would you agree with that
Correct.
statement? Okay. All right. Perfect.
Yes, absolutely. Because you have to factor in how long the warrant's good for.
Yep. Okay. Thank you. So let me just ask this final question. Is there let's just say there's a book for dummies on warrants that you can recommend to the audience to pick up in your, experience? I just, any book or any website or any type of resource that you're aware of where one, if they wanted to do a little bit more, groundwork.
I'll go a step further, and I would say that, especially the American listeners, viewers, they need a full-service broker that deals with Canadian securities, if that's what they're in fact investing in. That understand Canadian securities, understand warrants, understand exercising in the process they've got to go through, the time frames they take. They do themselves a great disservice by trying to use somebody they've just been using for years that doesn't have this expertise, or worse, a discount broker that, look, it's no different than you going into a restaurant and serving yourself because it's a buffet. And by the way, the water is over there, help yourself. Versus going into a full service, fine dining, and yes, you're paying more for it. Hopefully not a lot more, but you're paying more for it. But they're looking after you. If the problem was anything, you have a server that's going to help you. And don't nickel and dime when it comes to that, because if you miss an expiry on a warrant, and you're in the money, my goodness, you've left a lot of money on the table that would more than compensate for any commission differences I'm talking about. The other thing too, and I don't know about the U.S., but I do know in Canada, most discount brokers will not even deal with warrants. You then have to exercise it directly through the company, which is not over the top, but it's one more functionality that you've got to process that if you're reasonably unsophisticated, you're gonna struggle with. So back to your question, do I know of any website? No. I've been in this business well before the internet, so I'm sure there are probably good sites for what we're talking about. As far as books go that might be involved in certain Canadian securities books that talk about warrants, but it would be dumbed up or not dumbed down. It would be talking kind of language that you may or may not understand. Again, the best person would be having a good financial advisor that deals in this area. And I can't emphasize that enough, especially in America. I have a lot of American friends that pull their hair out when it comes to dealing in Canadian markets, because they're dealing with brokers who, don't typically deal with venture companies. They deal with blue chip U.S. stocks, which is great, but they don't. This is almost a nuisance to them, and so they want to do it as quickly as possible. And there's not a big incentive other to keep their client to become overly familiar with it. And in a lot of cases, you get talked out of doing things that you may want to do, and they'll put the fear of volatility into your mind, and you may not even do it. So that's my answer. Find a good broker.
Well, it's a great advice, Bill. I mean, thank you so much. You always go above and beyond my wildest expectations. So this is invaluable to all of us and my audience, and just thank you. That's all I could say is I appreciate your knowledge and having you on the show and available, and me being able to record this so I can replay it over and over again and write this down and share it with everyone. And I would love to have you back again if you would ever be open to that idea.
I'd love to, Gena. Thank you very much. And next time I see you at an event, conference, I'd be happy to do this in person and get a picture to the voice. But with our high-tech abilities today, we've managed to get it done this way.
Exactly. So thank you so much.
Thanks for listening to our show. Repetition is the way we learn. If you enjoyed our show, leave us a comment below. Knowledge is to be shared, not hoarded.
I knew what I needed, so I went out and got it. Started stacking up assets, now I'm bringing in profits. I knew what I needed, so I went out and got it. Started stacking up assets, now I'm bringing in profits.
Visit www.a2ainvestor.com where you can get other tools and knowledge.